What an intro. Fantastic intro. Feels like I'm on a real show here. Thanks for joining, everyone. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisor Group. Thanks for joining. Today is, what are we today? June, my shirt's messed up here. June 15th, 2020. I'm live from 201 Portage Avenue in downtown Winnipeg. Really interesting guest I got on today. Last time he was on, he made a few bold predictions, and they pretty much all came true. He wrote a piece last week, about a week and a bit ago, and I emailed him when I saw the piece. I said, Javed, I want you back on the show. He's coming back. He's back on the show. Let's bring him in. Let's delay him no longer. A man who doesn't need introduction, but I will introduce him anyways. Javed Mirza, quantitative technical analyst and researcher from Canaccord Genuity Corporation. Welcome, Javed.
Perfect, Rob. Thanks so much for having me.
All right. Thanks for being here. Let's start before we get into kind of the technical analysis and some more technical details. Let's talk maybe with the headlines today. The market started off, I think the big headline is absolutely most definitely the fact that the market started off, well, when I woke up in the middle of the night, it was minus like 1,000 points or something. By the time I got to the office, it was minus 700 or 800 points, and markets opened down, I think 650, and rallied throughout the day. That'd definitely be the headline, I think, of the day. What are your thoughts on a move like that in one day?
It was pretty positive. I mean, obviously, we had some commentary out over the weekend that put the markets under pressure, but the rally today was good. It was pretty strong. And it looks like, our recent call about the consolidation, it looks like we're trying to hold the line here near important support. So it's all of this is very positive.
Yeah, I think, CNBC's got the headline as the markets rally, the markets close 100 points up as Fed announcement sparks big comeback. So do you think that the Fed announcement saying that they're going to buy individual corporate bonds, do you think that had a big part in the comeback?
I don't know about a big part. I think it definitely had a part in the rally, but just from our perspective, the markets had a really big correction last week. We had a negative 7% day in the Dow, so on Thursday. So obviously that was challenging, but markets have gotten ahead of themselves, and that's what we've talked about over the last couple of weeks. And now, they've pulled back a little bit, and it looks like they're hit support, and it looks like they're ready to run up for another up leg here.
As a reminder, if you're watching this on Facebook, please like, follow, and share. If you're watching it on YouTube, take a second and subscribe to our channel. I want to get to 2,000 subscribers. I'm not quite there yet. I need you guys to be there. Plus, you're going to know about the great content that comes out. Javed, the BNN, one of the articles that I really like is Hertz. Hertz said that it expects, so Hertz, as you and I both know, filed for bankruptcy, and then the stock started trading on kind of these discount platforms, as Robinhood and these discount platforms, and they've announced in their filing that they expect stockholders to lose all of their money. And they did a filing, I believe it was $1 billion. I could check the exact numbers, but they're basically doing a new issue. So they're raising capital, given that the stock price has run up so much. What are your thoughts on a bankrupt company raising capital, one, and two, telling people that they're going to lose money if they invest in the IPO, or not the IPO, the new issue?
Well, I think they're just covering their bases in terms of a risk and disclosure standpoint there. Look, it's, we've had a fair bit of speculative activity over the last, I'd call it 2 to 4 weeks. And this is on the back of the markets, plummeting from February to March. So you expect the market to get a little bit ahead of itself. Not many people really saw this V recovery coming. And as a result, at the end, I think people started to get a little bit of FOMO. And I think Hertz is being smart here in terms of they're taking advantage of it. So
in Canada, the headlines include that the feds are looking to extend the CERB payments. This is today, Prime Minister Trudeau announced. Also, the other headline that I think was kind of a neat deal is that Shopify was up about 6% today after they announced a third-party deal with Walmart. I'm not exactly sure all the details, but I mean, they've partnered with a giant. And as a result, the market like that, the stock is up. I believe they'll be working. I think Shopify's got more third-party market than Walmart does. And I think Walmart wants to expand their game, and I think it's a natural fit for Shopify. That stock was up, wasn't it up 8% or something today?
I think big. At 1 point, yeah.
Other Canadian headlines, Cineplex shares tumble as the deal fell apart. And there's also a headline here about Canadian home sales are the weakest since 1996. But remember, folks, as I've mentioned before on my global TV, if you're watching it, a drop in sales does not necessarily mean a drop in prices, as what we've seen in Toronto and Vancouver anyways, was that there was a drop in volume, but not necessarily a drop in price. You could sell half as many houses, but if you sell them at the same price, the prices obviously aren't suffering. You wrote a piece. Any other headlines that I missed today, folks? By all means, if you do have questions about any of the headlines, please go on Facebook or YouTube or wherever you're watching us and let us know what your questions are. Sports are starting up again, Javed. That's huge for me. My Winnipeg Jets are in the playoffs. They're going to be the 9th seed. They're going to be playing in Calgary against Calgary. That's pretty exciting. Any other headlines that I missed, please, by all means, let me know. The piece you wrote about a week and a bit ago was a North American technical comment. You write these regularly. I want to say, every 2-3 weeks or something like that?
Every weekend. Every weekend. Yeah. We took our first weekend off this week.
How dare you take a weekend off? By the way, Javed is actually on holidays today. I think you're on holidays.
Yeah.
And you're actually working with us on your day off. That's how cool Javed is. Way cooler than I am. So the risk, you wrote a piece titled "Reversal Day in Risk-Off Assets Points to Short-Term Equity Market Consolidation," and this was dated June 7th, so Sunday, a week ago. You wrote that you expected a short-term equity market consolidation. I reached out to you. I said, Javed, let's get you on the show to talk about this. Lo and behold, by the time we're here a week later, we've already had the risk-off equity market consolidation. So what did you see last week?
So what we saw was that a couple of risk-off assets, so namely bonds, the volatility index, the VIX, and gold were all showing signs of, they gapped down, not this Friday, but the Friday previously, and then they rallied, which is basically the same action we saw today, where you started at the lows and then you rallied throughout the day. And so that really caught my attention and to me suggested that the rally we saw in equity markets last week had run its course. So we wrote this on Sunday, or we put it out on Sunday. We work on it on Saturday and Sunday. It came out on June the 7th. And then I think we rallied on Monday, and then Tuesday, Wednesday started to sell off a bit. And then Thursday, of course, was the big sell-off day. Tried to rally a bit into Friday, but I think people were scared about holding over the weekend. And then, of course, today we had the rally into the close. So I think from what we're seeing here today, it looks like the short-term pullback here is likely to be over, and we're going to try the next up leg. And that's what we've talked about over the last couple of weeks, is that we saw this short-term corrective phase, which I think we've seen, and then we have one more up leg, which will take us some point in the end of June, early July. But that being said, there's still one bigger corrective phase coming. I think this summer is going to be choppy, and it looks like we'll likely have some sort of bigger correction, probably something around the lines of 10 to 15% at some point over the next, probably in July or August, it looks like.
You talk about your some of the reasons that you think the equity market consolidation is coming is that you talked about the put-call ratios were at bullish extremes, consistent with prior intermediate peaks. So you also talked about the smart money having reduced their exposure to copper and WTI crude.
Yep.
These are things you tracked, and you talked about defensive sectors showing early signs of relative outperformance, which is something you follow when you take a look at technical signs on a market.
Yeah, exactly. So all of these things to us suggested that things were a bit frothy and the market had gotten ahead of itself, and that portfolio managers at the margin were already starting to position defensively. So all of these, when you have one or two signals, then you look at it, but it doesn't really alarm you. But when you have 5 or 6 things saying the same thing, it's you really have to step up and take notice. So the key point or the takeaway is that most of these conditions still remain. So the smart money is still pretty short crude and copper here. So although we expect at least one more short-term rally attempt here, we think that once that is done, through July, August, the market's going to have a little bit of a choppier time and choppier window.
You say July, August. Is that a technical sign, or is that supposed to coincide with anything that's happening in the market? Like, I know that's earnings season around that time.
Yeah, and it's also seasonality. Typically, that's where a lot of portfolio managers take time off, and so it's the indicators that we have suggest we've had a really good run over the last couple of months. I think a lot of people will likely look to take some money off the table. So I think that the setup is there for a bigger corrective phase.
Okay, so I'll get to kind of your points about the timing of these next sector rotations or whatever you want to call them. As a reminder, folks, if you're watching this on YouTube, please take a second to subscribe. On Facebook, give us a like or follow, and by all means, share any questions you might have. I'm here live with Javed and Mirza, quantitative analyst and technical researcher from Canaccord Genuity Corp. Do not take this as investment advice. If you're out there and you're watching, don't take this as investment advice. This is technical advice on specific sectors and specific stocks. Javed doesn't know your personal situation, neither do I. Let's get into the next page here. We talked about, I'm going to just go a little bit here. You talk about some thematic ideas here. I'm going to skip ahead here and get right into
probably page 7.
Yeah, page 7 here, where we talk about the S&P 500 right here, figure 5.
Yep.
So this is two charts for those of you that are watching at home. The figure on the left is the S&P 500 weekly. This is a 3-year chart. And the figure on the right is the S&P 500. It's a daily chart for 9 months. Now, why at the bottom there's a ton of stuff, but you talk about MACD, you talk about SPX divided by VIX, and you talk about the price, and then you talk about buying, selling pressure. Do you mind taking us through those and why they matter for technical analysts?
100%. So what I'll focus on is the chart on the right-hand side for right now, but I don't want to overwhelm your viewers. But the key takeaway is if you take a look at the chart on the right-hand side, that's the daily chart of the S&P 500. So what you can see in the top panel, all that is price momentum. So it's telling you whether the price momentum is moving higher or exactly right there, Rob, or lower. And then right underneath that is another indicator called overbought or oversold. And what you can see is, you've had a pretty good run here. So it makes sense that you're starting to get a little bit overbought. And what that means, overbought, it's just you've had more stocks that are at near price extremes.
What's the specific measurement for overbought and oversold?
There's a wide variety of indicators. A common one is RSI, which we use as well, and it's
relative strength index.
Yeah, and it's just measuring the price of any financial instrument relative to itself over the last. I think it's typically 15 or 26 periods. But the key takeaway is it's just telling you that the index obviously has had a pretty good run. Now, what's interesting in the bottom panel is what that is an indicator, and you can see that black line that goes up and goes down. It's just an indicator of buying pressure. So it's very simple. It's one of the first things I learned when I first started doing technicals over 30 years ago. And what it is it's just if a stock closed up on a day, you add that indicator to a running total, and if a stock or financial instrument closed down, you subtract it. And the reason that's important is because you want to see this indicator increase over time, because what it's doing is it's showing you there's more buyers than sellers. So what you can see with that blue arrow is that this has continued to trend higher, which is positive.
We're talking the bottom
arrow. Exactly. Yeah. But what we said when we wrote this, and remember, we wrote this on Sunday, not this Sunday, but the previous week, and we said, look, here is important support. So I'm just looking at the middle panel there and just highlighting that blue shaded box, and that it was between 3,000 and 2946. And so that's actually where we came down to and where we're sitting around today. So all that we did over the previous 2 weeks was just basically we moved up quite parabolically, and then of course we had the big correction. So what you had happening in the first week of June was some FOMO, people with fear of missing out, and they were piling on. And then what you had last week was a retracement of that entire move, and you've come back to major support. And basically the last 2 weeks, it's as if they never happened. And now from our work, it suggests we're going to try and rally again and potentially push out to new all-time highs. And that's what you and I talked about when I was on here, I think about a month ago, is that we're going to hit new all-time highs, and we hit them on the NASDAQ last week.
Yeah, May 7th, 2020 is the last time you were on the show with us, just over a month and a bit ago.
Yep.
And you talked about hitting new all-time highs. And I remember I was like, new all-time highs? Javed, are you crazy? But no, you were right. As it turns out, your technical signs were strong. The NASDAQ did hit an all-time high. And we're continuing to see some of that right now. So I'm gonna go to the next. By the way, guys, if Javed, I can share this deck with our viewers, right? If they ask me for this,
I think you could double check with our team, but I would just double check with them.
Yeah. So if you're hungry for this kind of data analysis, please reach out to either myself, send me an email, or Diego Guzman. Send it to rtetrault@cgf.com, and we'll get you the compliant-friendly version of it. Let's go on to the next slide here. We're taking a look at the TSX composite. This is equities. Again, the 3-year and the 9 months. So you talked about support. What are you seeing here with respect to support? And maybe pause just a sec and explain to us what support is for a stock and resistance.
Okay.
I know for you it's second nature. But.
Yeah. So support is a level where historically the stock has a trouble moving. Sorry. Resistance, we'll start off with resistance, is an area where the stock traditionally has an issue moving through. And all that means is that from a fundamental perspective, there's a variety of different people who are using different techniques and approaches in the market. So it's fundamental, it's technical, it's quantitative. And what all it's telling you is that level, for whatever reason, is a common level that a lot of people agree on is important. And if it's a resistance level, it means that people are selling at that level. So let's say they're fundamental analysts. Their work is telling them that at this level, the stock is overvalued or fairly valued. Same thing from a quantitative perspective. And as technical analysts, we see the footprints that these other market participants leave, and we utilize them. And so what I would highlight here is you can see that 15,222 level. It was initially, it was resistance. So if you notice, back in early May, we tried to break above it, but we couldn't hold above it for more than a day. And then we just came back. And then you see that 14,270 level. I don't know if you can blow that up a bit, Rob. But yeah, we're exactly where your cursor is. No, where your cursor is fine.
Yeah, I'm trying.
And what happened is we tested that 15,222 level. Then we came back to the 14,270. And support is the opposite. So it's a level where fundamental or quantitative investors find whatever financial instrument they're looking at is attractive or undervalued. So what's happened over the last couple of days is, lo and behold, is we've come right back to that 15,222 level on the TSX composite. So we had a pullback. We're right at that level again. And what you'll notice is that these levels, support or resistance, tend to become magnets over time. So let's say we're talking about a stock. A stock will trade to a resistance level. It'll fail there, and that's what's happening is fundamental investors think it's overvalued at that point. Then it'll pull back a bit under the weight of that selling pressure. And then if there's buyers who, for whatever reason, are looking out further and they see, like, on the stock you mentioned there, that the Shopify, that they have some agreement with Walmart that fundamentally changes the outlook, then you can see that things have changed once it breaks through that resistance level. So one of the things that we're looking for next is a break above the 16,000 level on the TSX. On the TSX, exactly.
So that was the last kind of resistance level. And if it break through to that, would likely, I think what you would say would push it to a next resistance of 16.9.
That's exactly it. Yep. And so what it's telling you is that, the fundamentals have changed, they've improved, and now we're pushing higher and heading higher. So all of this is really positive.
Okay. I'm going to try to zoom this in for some viewers here. So maybe I should go to, do you want to stop and touch on the NASDAQ here? And
sure.
I mean, it's largely the same, but what I'm going to try to zoom in here for a sec, but go ahead and tell us about the NASDAQ 100 here and what you're seeing. And I'm going to try to fix this.
So what I'll do is I'll talk about the weekly chart on this one because I think this is more relevant because we've broken out to new all-time highs. So it's really positive. It's funny, you've heard that saying, buy low, sell high. Well, typically what we do from my field is we like to buy high and sell higher. So the stocks or I guess investments that we're looking at is typically stocks or indexes that are making new all-time highs because it's showing you that there's a lot of power behind the move and a lot of basically a lot of investors are aligned and supporting that move. So it would be the chart on the left-hand side, Rob.
On the other one, sorry, on the left-hand side.
Yeah. The only reason is because I'd focus on the weekly chart here because we've actually broken out to new all-time highs.
Right.
And you can see that there, the 92.64. So it's been a very powerful move. We had that consolidation last week, and now it looks like we're ready to reaccelerate and go to the upside. So from our work, it suggests we have another week or two of upside pending. And then come end of June, early July, it looks like it's time to take a break and a pause and, spend the time with your loved ones and take a step back from the markets.
What do you think that step back from the markets is going to look like? I know that's tough. On a technical side, what are your technical indicators looking like? So let's say we rally through here, the NASDAQ as an example. So we rally through to 10,000 and I don't know, maybe we get to 10.5 or something or 10.2 or 10.3. Yeah. Do we retest kind of the 8.488 lows or how far would resistance, how far would the support have to, would we break through the first couple levels of support there?
Yeah, I think we'd probably come back to at least that 89.67, so around that 9,000 level. Notice we've played around that level a couple of times. It was resistance and then support. But yeah, if that fails, do you see that blue line, the blue solid line there? That's the 40-week moving average. You can kind of see it snaking. Yeah, exactly. You got it, that line. That will be the next major support. It's equivalent to the 200-day. So if any of your viewers are technically savvy, they'll know that's an important moving average that technical analysts use. And it's just an indicator of a longer-term trend. So if we break below 9,000, then we're definitely going to test the 200-day. And that's typically a logical bottoming point. So for instance, if you scroll down a little bit, Rob, if you take a look in May, July of 2019,
right in here.
And notice that's exactly it. But notice the blue line is right at that level. So you see how so that's like, and then notice again in October, November of 2019, we pulled back and we held right above that blue line. Exactly right where you are.
Yeah, the moving day average, for those of you who don't know, I mean, the reason it's a significant, it smooths it out, right? Because you're taking 200 days or 40 weeks in your case, and you're smoothing out an average over an extended period of time. And support resistance above those have always been technically strong signals. Can you touch on historically why in a technical analysis support becomes resistance and vice versa? And is that always the case? Once you break through support, does it always become the next resistance?
Yeah, exactly. That's important because, and I think we talked about this when we went through my last presentation, is it was on the margin important, probably in the 80s and 90s. But what's happened is there's been a big shift. So in the 80s and 90s, what people followed more was fundamental analysis. And there was a lot of, for lack of a better word, they were telling stories about stocks, right? And then, they would say, this is what's going on, this is what's happening, and investors would gravitate to a stock based upon the story, which of course was backed up with fundamental analysis. And what I mean by that is, looking at price earnings or price book. But what's happened, especially since the late 90s, early 2000s, is you've had more and more investors that are focused on using mathematical models and quantitative models. And a big input into these models is technicals. So it's just previous resistance levels, previous support levels. And because of that, these technical levels are going to become more and more important going forward as well. And so these technical indicators, so like if a stock is trading below the 200-day moving average, you're going to have less investors in it than if the stock was trading above the 200-day moving average. And the reason this is important is because at the margin, and I'm sure you're aware of this, Rob, is that more and more money is being moved by quantitative and technical funds.
Well, you talked about it. The what did you call it? The rise
of the machines.
Yeah. The Terminator reference.
Yeah.
I'm going to pull up a slide here on sentiment, I think is the next slide we want to go to.
Okay.
So this one you talked about, and I believe that the reason you mentioned it is the S&P 500 advanced decline. It might be a tad too zoomed in here.
No, it's perfect. Just go down and go down. That perfect, and then just scroll over to the right. That's perfect.
Yeah.
So this chart at the bottom is the S&P 500, but that's not as important. What we're looking at here is a couple of indicators that really caught our attention. So we highlighted them with those red circles. So the top panel, the third panel there, investor sentiment. If you recall, Rob, a month and a bit ago, we were very bullish. And the reason was, by and large, investors weren't buying what was going on. And so not this week's piece, but the previous week's piece, we actually called it the jig is up. And the reason we called it the jig is up is because if you notice right there, investor sentiment had started to turn up. So you see how it was below that blue line? Yeah, what that is telling you is that investors were very bearish. But over the last couple of weeks, they'd started to get bullish. Now, if you scroll down a bit, take a look at what happened to the S&P 500. It just kept moving higher. So as it kept moving higher, that literally one 4-letter word, FOMO, right?
Yeah, that's nobody wants to miss out the party.
That's exactly what happened. So, and when everyone else is partying, that's when I get scared, right? So when everyone else is scared, that's when I'm very happy. So that's why back in March, we said, look, we think it's a V bottom because everyone was, there was a lot of fear and a lot of panic. And our job, for lack of a better word, is to predict the future, right? And it's really hard to do. But there's a great series by Isaac Asimov. You ever heard of Foundation?
Yeah, I have. My sister's a big fan.
Yeah, and what the Foundation, all it's based upon is they predict history based on the human population at large. So it's hard to predict an individual human's behavior, but the one thing that hasn't changed for the last, 100,000 plus years is how we as humans behave, right? So that's ultimately what I'm doing, is I'm trying to predict what humans as a whole will do. So if you move back up to that indicator, so that's why over the last couple of weeks we've been getting a little concerned. And then right underneath it is another indicator, which is called the CBOE put call ratio. And that indicator is actually, it's basically an indicator of fear and greed. So when people think the stocks are going to go up, they buy calls. And when people think stocks are going to go down, they buy puts. So exactly where Rob's cursor is right now, what you can see is on the June 7th, when we put this together, almost everyone thought the market was going to go up. So that's why we were very concerned. And that's why we put out this note. Look, all these factors are coming together, which suggests the market's going to pull back. Now, as again, I would say, did we know it was going to pull back 7% in one day? No. But we knew that all these indicators were aligning such that there was going to be a corrective phase. So that's why we wrote it. And that's why we put out that note saying, look, the risks here are of a correction. And we think it'll come back to around 3,000 on the S&P 500. And that's ultimately what ended up happening.
Puts and calls, for those of you who don't know, are derivatives. So these are derivatives. So these allow you to buy the right for something to happen. So when you're buying a put, you're buying the right to sell something at a future date at a specific price. And if you're buying a call, you're buying the right to buy the market or an index or an underlying at a specific price. So you're basically it's a derivative. So it's a form of effectively gambling on what's going to happen in the future, and it's leverage because you can oftentimes pay a very small price for a future move of an index. And if it goes up 10 times that much, you only paid $1. You could leverage your returns dramatically. And that's why Javed monitors this, because a lot of the gambling money ends up being put on puts and calls. I think you would agree, and some hedges as well. So if individuals are hedging, a portion of their portfolio. They might put a put on a portion of their portfolio. Javed, should I go to the WTI slide or the?
Yeah. Whatever you think is most topical.
Yeah, give me 1 second. I'm going to pull it out. In the meantime, you had talked about. So today energy closed at 37.07, up 81 cents.
Yep.
That's, not as high as it had been. Obviously, in the past, we saw the same trade that happened on the equity markets.
Yeah, that's perfect right there.
Yeah, you know what? I'll go back to the other one. It's good size.
Yeah.
So you put out 8 days ago.
Yeah. And so what we highlighted is that we're just cautious here. And if you actually move over the slide, move just over to the right, I can talk about just the daily chart. So what we highlighted here, that red shaded box, is just, we said, look, this a move into this zone is where we would look to lighten up on energy. And what I can do is, I'm just at my computer right now, and I can just take a look to see where we ended up getting on crude. So what's happened is we've come right into that zone right here. So it's between 41.28 and 34.36. And so if you take a look at the weekly chart now on the left-hand side, so that's where we would be lightening up on crude. So do you see that 40 level?
Yeah, right here, 40.06.
Yeah. And so what you can, if you move across that line where it says 40, what you can see is that over time, it's been support and resistance. And you can see that very clearly with 50 as well. Notice over time, 50 has been a pretty good barometer of where it moved higher when you're above it, or it bounced off it. You see that exactly right there, Rob. You see how it's like, exactly. A lot of times where it bumped up against it and then failed, or where it finally moved higher. Now 40, especially if you go back to 2016, 2007, exactly right there.
Here.
Exactly. Notice that it was a pretty big support level initially, but what it is right now, it's a big resistance level. So notice where we are now. We've had that big rally right to that level. Yeah. And as you know, things don't go up forever. So especially if we think that the market's going to consolidate, then crude, which is more of a risk on and cyclical commodity, should come off as well. Now, what's really interesting is take a look at the bottom panel. And what that is that's a measure of smart money. The red at the top is hedge funds, and that's how many contracts they have open. And the green line at the bottom is commercial hedgers. So these are the producers of the underlying commodity. And what they're looking to do is hedge their production. And they are the ones that typically have the most information. And what we've highlighted with those blue shaded boxes is whenever commercial hedgers are very short, so if you notice throughout the history of that data series, they're always short. So they're always below that zero line, that kind of horizon line you can see there. But there's instances where they are very short. And so what's happened over the last couple of weeks, especially as we've had this rally, is that they've sold into this rally, and now they're positioned at levels where traditionally, once they're positioned at these levels, you tend to see a pretty decent correction. Now,
so the idea there, Javed, idea there, just sorry to interrupt, is that these commercial hedgers, they're often running very large ag companies, and they're actually truly hedging their
exactly.
crops, or maybe they're feeding animals or whatever it may be, or they need oil for to put into their their factories or whatever it may be. But that is what you would call the smart money, just so I'm clear.
That's exactly it. So who would you rely on
Absolutely.
Who would you rely on for a grain forecast? A farmer in Manitoba or some trader in Toronto?
Yeah, no, I'll back my farmers here in Manitoba. Absolutely.
That's exactly it. That's what I look at, and that's what these guys are saying.
We've talked about this. We've kind of followed this and talked about this here internally with my dad and I for years. How they're always going to be right, because those traders. Well, they got real money on the line, these hedgers, and they're truly trying to hedge risk in their portfolios, and it's long-term decisions, right?
Yeah, and salt of the earth. They know what's going on, right? And they've been doing it for years, and it's in their blood. So, and that's what we're looking at, is I want to see what the smart guys are doing. And what the smart guys are doing is they've started to reduce their exposure to crude here, and they've locked in prices and effectively they're locking in their exposure at these levels. And when they do that, it means they don't think it's going to go higher, or at least not in the intermediate, over the next couple of months.
Can I ask you, so for stocks, would you agree that, or would you think that for oil prices, the kind of the numbers in the sand of 40, 50, 30, 20 mean more in commodities than they do for stocks, or is that not true?
It's funny because certain stocks have trade
Psychological
differently.
barriers, right?
And this has happened from way back, and I'm sure your dad will remember this as well, is basically in the 90s, 2000s, you had guys who were pros on certain stocks. And so whatever the pro traded, he would be a big mover of money. And so every pro had different, they used different levels, they used different tools. Some guys were fundamental only, some guys were technical. So the professional or the proprietary trader, he would often dictate how a stock traded. So I would say it's individual for a stock. So like a Microsoft would trade a bit different than an Apple in terms of key levels. But sometimes you do see that, especially in commodities. There's this theory called Elliott wave theory, which I don't really get into, but I'm sure some of your viewers might know about it. And commodities definitely seem to follow that Elliott wave theory a lot more.
So the psychological numbers, they move up and down, and I guess the traders. Can you talk maybe a bit about the pros? Wait, before I do that, I'm with Javed Mirza here on YouTube. Please take a second and subscribe if you're watching on Facebook. Give us a like, a comment. We'd love to hear your questions. A follow. Can you explain what a pro trader is for our viewers, and how many are there in Canada? Would there be one at every bank? Would there be one at every investment firm? How did they work back in the day, and how do they work today?
Yeah, so there's actually less and less ever since the financial crisis. They've really regulated and pulled that back. But basically what happened is the banks used to have excess capital. They'd have trading desks, typically of 10 to 20 people, and they would just make bets based on what they saw happening in the market. So these guys were, really smart guys, because you could tell, because their livelihood was based on whether their bets on the market were correct or incorrect. But after the financial crisis, you had all this regulation, and it made it really difficult and tough for the banks to continue with that. And there's pros and cons of having proprietary traders. Obviously, the con is, the more risk taking, but the pros is that you have more liquid markets. So, and because they'd be forced to hold inventory in certain names that they were the pro on. So it would make for more liquid markets and for better price discovery.
Right. And less machines, right?
Yeah. And they've been effectively replaced by machines.
Yeah. I was going to take you through the natural gas, but I think I'll take you through to the gold chart. I think that makes sense for the next chart. Yep. People ask me about golds from time to time.
And then maybe if there's enough time, we could quickly talk about Canadian dollar as well.
Oh yeah. No, I'm taking you. That's next. I'm going to take you to gold, and then we'll go to CAD. So I'm going to share this screen here. This is slide 18 on my end. I'll zoom in depending on which one you want me to show here. Yep. So this is precious metal. This is a monthly chart for 24 years. I'm going to zoom in. There we go. There's our 24-year chart monthly.
Yeah. So this is gold. So what's happening here is, gold's had a pretty good run here over the last 2 years. And what I would say is, if we can get above that 1840 level, which you can see, it's an important resistance level, then the next upside target, I think I wrote in there, is it's, I think, around 2200. I don't think I wrote it in there. I've had that in a separate note. But what's interesting here is the commercial hedgers. They have been short for a while here. So if you scroll down to the bottom a bit, but what's happened over the last basically 2 months is they've actually started to unlock their exposure. So they actually think that gold's going to move higher too, which is a positive. So this is all of this, especially if you can get above that 1840 level, is very positive. It says the next target on the upside is around 2200. Now that's all longer term. So this is what I'd be looking at over the next 2 to 4 years. Now, if you take a look on the right-hand chart, this is what's happening with gold right here, right now. So remember, this is This is about a week ago. So let me just pull this up on my computer. Just want to see what's happened
Today
here.
we closed at 1732 an ounce.
Yeah, perfect. So if you take a look at that chart, you can see the levels that we've highlighted there. But basically, you see that 1677? That's important support. Notice over the last couple of weeks, we've touched that level a couple of times. We've held above it. And notice that we were testing that level. When I wrote this, it was on the Friday. But we actually held above it. And you see that 1769 to the upside? So that's resistance. So what it's looking like to me right here, right now, is it looks like gold actually wants to test that 1769 level. And if you can close above that level, that's very positive. And that's going to say the next upside target is around 1850. Now, the reason that's important is if you take a look at the chart on the left, that's a test of that major resistance level. So if you get a test of that 1840 and you get a breakout to the upside, that, you know, you would definitely see a pretty good move. I think you could probably get to 19 or 1950 pretty quickly. But after that, I think you'd see a pretty lengthy consolidation.
Okay. I'm going to take you to the Canadian dollar here. So that is, I think it's page 25, if I'm not mistaken. We get a lot of questions about the Canadian dollar. And
that's why I figured it'd be topical for your viewers to hear about it.
So on the left here, we have the weekly chart, 3-year weekly chart. And then on the right, I believe, is a daily chart.
Yeah.
But I'll let you decide where to start here.
Yeah, so let's start off on the weekly chart. So what I told people is, and as you can see it at the bottom, in the bottom panel there, take a look at the green line. That's commercial hedgers. That's the smart money. So these are people, importers, exporters, who have to hedge their Canadian dollar exposure. So notice that they've started buying over the last couple of months. But what's happened as we've had this strong rally is over the last 2 weeks, they've started to sell into the rally. So the reason that's important is notice we've come right up to around that important resistance level around 73. But what's more important is take a look at the chart, start at the left-hand side, and work your way just slowly to the right-hand side. And the key takeaway, and this is what we talked about when I was on your show on May 7th, is that the longer-term trend, and this is over 5 years, is down. So the reason that's important is you always want to pay attention to the longer-term trend, because that's the key driver. So now if you take a look on the right-hand side, and what we've done here is we've drilled down and we've taken a look at the daily chart. And this is what we were telling clients is, look, Canadian dollar looks like it is testing important resistance. And because what we were highlighting is that the smart money had been selling the Canadian dollar, that it was likely to stall here and fail. And so we were telling clients to reduce Canadian dollar exposure. Now, if you take a look at what happened, I'm not sure if but basically we closed today at 73.50. So we're actually, so it's had a big drop since then. So you can see that support 73.19. Guess what the low today was?
73.19?
Close, 73.20. So we got right to that level, that support level. I think it's going to bounce around here for a little while, but the longer term view is, especially if we have this correction in the summer, because remember, the Canadian dollar is very much a commodity currency. So if, Rob, this is what we talked about at the start of the show. Smart money is reducing exposure to crude. It's reducing exposure to copper. We have a lot of oil and copper producers in the country and on the TSX. So if those commodities are going to go lower, then shouldn't it make sense that the Canadian dollar is going to come under pressure too? So I think, you can quote me on this next time I come on sometime later this summer.
I can't wait.
Is that the Canadian dollar, I think, is going to be around that 72 to 71 cent level over. So I think it's going to drop another 2 cents over the next couple of months.
Yeah, those of you that have been following me on this show or following me, those of you that are clients that have been asking us about our position on the Canadian dollar, we've echoed this statement now for a while. And we think if you're thinking of converting, if you need USD, it's likely to get worse for the CAD. So yep. I'm on your same page there as you, Javed.
Perfect.
Anything else you want to highlight on this one?
No, that's about it. I think that's the main points. It's come right to that resistance level, And that's and that's what, back to your question earlier, what that's saying is around that 75-cent level, a lot of portfolio managers in Canada, a lot of macro economists, they're saying that fundamentally at 75 cents, the Canadian dollar is a sell, or it's overvalued.
What do you think the long-term range is on that Canadian dollar? Would you ever go out like 5 or 10 years on the technical side?
So on our show last time, I look out 10 years, I think it's going to 63 cents.
Crazy. Yeah. Well, crazy, but not definitely. It's just a big move from here.
Yeah,
I'm definitely bearish on USD versus CAD. Yeah. Sorry, bullish on USD versus CAD. I'm pulling up a financial services chart here.
Yeah.
I think this one's interesting because of the how bad it's been for financial services for a while here. And this is S&P TSX Cap Financial Services Index.
Yeah.
This is a June 5th chart.
Yeah.
What are we seeing here?
So what we're seeing here, in my view, is we've had a pretty big move lower over the last couple of months, of course. From our work, everything that it says in the markets, as long as they hold around current levels over the next couple of months, is that we're starting a new bull cycle. If we are starting a new bull cycle, typically at the start of a new bull cycle, financials do well. So what should happen over the next, for our work suggests over the course of the next year, is that financial services should outperform relative to most of the other sectors in the TSX. So, we've had a pretty big bout of underperformance, and so you should see money flow into these later this summer, and to help elevate this sector and help it outperform throughout into next year.
You look at the multiples, and I know this isn't part of what you do. I'm sure it is because you follow it somewhat, but you look at the macro side, just looking at fundamental analysis, and some of these financials that are trading at 8 or 9 multiples, and we know that historically they trade at 12 or 13 or 14 multiples, coupled with this technical analysis. I'm sure some portfolio managers would definitely agree with you. Anything else you want to highlight on this chart?
Nope.
There's a healthcare chart, the next one here. I'm going to take you to it. I think it's IT. Oh, sorry, it's IT chart.
Yes, that one's an important
information technology. Yeah. Do you mind going through this one with us?
Of course. So what we're highlighting is, notice the pattern here is, you see the blue boxes?
Yep.
Those are effectively sideways consolidations. But notice they happen in between periods where infotech has a pretty big run. So notice what's happened since basically the start of 2020.
Chart, right?
Yeah. So since the start of 2020, so over the last 4 or 5 months, infotech has been on a massive tear. So anytime it goes on a massive tear, after that, and that's why we highlighted these blue boxes, is you have this basically sideways trading range. So that's what we're highlighting, and that's what we think is going to happen over the next couple of months, is that infotech will, for the most part, effectively move sideways. You'll see some rotation into some of the more value areas of the market, and these are the ones that have been really beat up by all the COVID-19, economic damage. But our work suggests that over the next couple of months, it's effectively going to be a sideways move in infotech, but it should resume the longer term uptrend in, call it September, as we get into the fall. But the other key takeaway is this is our favorite sector in the TSX and the S&P 500 to deploy capital. So this is long-term leadership.
Long-term leadership. And explain to our viewers why, because it's a disruptor, because...
it's all of the above. It's, we've got this new secular bull market. It's funny because I literally was just driving in the car with my son the other day, and he was on my phone doing something, and I told him, look, when I was your age, what you held in your hand sat on my desktop, right? Like, just all the things you can do with your phone right now. Rob, when you and I were growing up, we didn't have that kind of, being able to text someone, being able to do some work on your phone. So society as a whole is much more productive than it was 20 plus years ago. And this will just continue. And our work suggests that this secular bull at least has another 10 years of upside, driven by
I sold
tech. Sorry?
I sold cell phones as my first job when I moved out. I was 18 or 19, and I was selling cell phones. And back then, like the bricks and the bag phones, and
you could hurt someone with those.
Yeah, we got the StarTax eventually, and then I remember when the Nokia 3360s came out.
Is that the flip phone?
This was like the long, skinnier Nokia that could do like 2 days on a battery, right?
Oh.
You'd have to like charge it every 4 hours. And then I remember they came around and they showed us a BlackBerry. And I remember thinking, who is ever going to want to send an email from their phone? Like, are you crazy? This is not going to work. Shows what I know. I was dead wrong on that. But I did end up moving a whole bunch of BlackBerries later on. I ended up working there probably 5 years in the St. Vital shopping mall here in Winnipeg. It was such a great experience. I learned so much about technology and phones and stuff. But I digress. It was actually a good time to be selling cell phones too, Javed.
Yeah.
It was nobody had a cell phone, right? It was like, anyways, I just showed my age. But
that's why you love disruptive technology, right?
Exactly. I want to maybe take a look at maybe one more chart. I was thinking maybe the lumber one. I know it's might not be relevant, but I think it's kind of neat. I'm just going to go to page 21 here. And, lumber for us at least in Canada it's a big part of our industry. So you do have a daily chart here, a 9-month daily chart.
Yep.
And then I think you have a weekly chart as well.
Yep. So I would take a look at the weekly. So all this is saying is look, we notice what's happened, and you can see this easily on the chart, is you held at important support around 250. So first you stalled. Take a look what happened back in February. You had a pretty big run. You went to 460. You stalled right at that 460 resistance level. And then you faltered. You broke through 380. You went through 300, but you held at 250. And now you're rallying, and you've come right back to that 380 level. This is a good point for a pause or pullback to take hold. And if you scroll down just a little bit, you can see the commercial hedger positioning at the bottom there. And what you can see there is that over the last couple of weeks, if they've started to reduce exposure and the hedge funds have started to get long. So this suggests that there's likely a pause or consolidation that's on the horizon. I think in the near term, you could probably get a pop maybe all the way to 415 over the next couple of weeks. So remember, we think there's going to be one more rally coming in equity markets and in the markets, financial markets in general. But I think at that point, you're likely to see heavy selling by the smart money. And I think that will be once you start to see a really bigger summer correction take hold.
So you guys have heard it here, and there's a couple things I'm going to be able to quote you on next time you're on the show. So I'm excited about that. A bit of a rally here that would last about 2 weeks, I think is what your work indicates.
Yeah, 1 to 2 weeks. Yeah,
1 to 2 weeks of a rally, and then choppiness into July and August.
Yeah, I think the probably 10 to 15% downside from where we hit the highs over the next couple of weeks.
10 to 15% from where we hit the highs over the next couple of weeks is kind of the new, will be the new support after that, kind of roughly.
Yeah.
And when you say markets, do you think more like the S&P 500 or the TSX, or you see them as a whole? Or?
So typically the market that we monitor and follow, or the benchmark, is the S&P 500. And the TSX follows, like all global markets are going to follow the S&P 500 to some extent. So the TSX, it's because it's got a big resource weighting, it's a bit different. So when resources are weak, it's going to underperform, which is what's going on now. But when resources are strong, it's going to outperform the S&P 500. So basically, the TSX is going to underperform the S&P 500 on the move higher. That's what's likely to happen. But especially, if our views are right here on some of these commodities, it might underperform on the way down as well.
And then choppiness, 10 to 15% move down throughout July into
August. Yeah, that's a bit harder to see exactly, like when exactly that move will end. But you get my weekly notes every Sunday. I'll always try to keep you on top of that and try to help you and your clients find better entry points for what we see is going to be a rally to new all-time highs into the
new all-time highs in 2020.
Yeah,
right on. And then continuation of a secular bull market.
Yeah. So next year should be a good year. And then maybe in 2022, 2023 is when we see the next cyclical correction, similar to what we saw over the last, I would say, if you recall, from October to December of 2018. Exactly.
18. Yep. Yeah. So 18 plus 4 years.
Yep.
So until late 2022.
Yep. Exactly. That's when we think it'll happen.
I like it. I like it. Those are precise numbers by a precise guy. I want to thank you guys, viewers, everyone for joining. We're excited for our guest next week, Johnny Mox. I believe I can mention we're having a show with Tony Dwyer next week. So he's our he's our big analyst, TV guy, portfolio manager, strategist. So he's big on CNBC. He's always on TV. He's got a really, really good mind. So we're bringing him on next week. The format's a little bit different, so make sure to monitor your emails. I think we're doing a webinar style event with Tony Dwyer next week. I want to thank you, Javed, today. We're going to get you back on the show. It's always a fun time. I want you to enjoy your holidays. Thank you, Javed Mirza, Quantitative Technical Analyst Research from Canaccord Genuity Corp. I want to thank our viewers for joining us. Thanks for tuning in. New all-time highs this year, a bit of a consolidation into July and August. Another couple of weeks of good time. So thanks for that. Go to YouTube, like us, subscribe to our channel. Sorry, like us on Facebook, subscribe to our channel on YouTube. And by all means, keep your stick on the ice. I don't know. I need like a catchphrase here, Javed, at the end of my show where I could be like, thanks for tuning in. But thanks for tuning in, everyone. We'll see you guys next Monday, same place, same time. Not quite same place, but same time. You guys have a fantastic day. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management. And a reminder, if you have any questions or you'd like to set up a no obligation consultation, please go to www.speaktorob.com. Thank you, guys. Have a great day.